There is no news, Carol. There is no news here.
Thinking.
It's just it's one of those days. All the newspapers are off today. Uh, Good morning and welcome to the Daily Energy Markets podcast. It is 10:30 in the UAE, the time zone that Dr. Carol Nackley is in, which is a nice treat. Welcome everybody, and we'll kick off this morning with Carol and joining us from Abu Dhabi. Of course, Carol, in her new position this year, as president of the Arab Energy Club and still CEO of Crystal Energy. It's that great thing where you become more recognized, you have to wear more hats and more jobs and not necessarily more pay, but that's the way of the world. More jobs, less pay. Dr. Carol, my question to you this morning is, what do you think are the legacy of this week, of this Trump tariff, American Liberation Day, as he has called it? We're in that window, this era of Trump's tariff Liberation Day. Regardless of where we go from here, which of course, as was mentioned off camera, could be anywhere, but ultimately, what do you think is the legacy that will last regardless? What is the damage already done that regardless of where we go from here is now baked into the new reality of the global economic picture?
Good morning, Sean. It's great to see you again. Thank you for having me with you. And yes, we are neighbors on this show today. Well, it's a big question because, first of all, I mean, in terms of structural lasting damage, it would be too premature to make any predictions because the situation is very fluid. One day there are more tariffs, another day maybe a pause and negotiations. So economically speaking, if I were to model that, that might be a bit tricky to do it from now. But I think the biggest damage is in terms of policy uncertainty created by the leader of what is supposed to be the free market economy, the country that for years and decades pushed for globalization. And yet today it's not liberation because I think it's going backwards because with its mercantilist protectionist policies. And I thought we have moved on from those policies and we have advocated all the benefits of global trade. Yes, there is the issue of fair trade, but define fair trade for me. And we have reversed that under President Trump. Whereas China, which for decades was the leader of the protectionist economies, if you want, and government anti-trade policies, seem to be stepping in and then saying that, hold on a minute, we're not going to change our policy, we're going to remain more open to global trade. So we had this kind of sudden reversal in the hats war by the two largest economies in the world, the US versus China. And that for me would be the interesting legacy that we will look at in the future. Now, depending on what the tariffs, final policies for tariffs will be, then we can meet again and discuss the damage created by those tariff policies, the impact on global trade, because I know as an economist, the more you put barriers for economic activities, the more you're going to slow down that economic activities. And again, it depends on how lasting those tariffs are. How do you treat different countries? Because it's not just a question of imposing tariffs on China. China has its fingerprints everywhere. It had trade relations with almost every country around the world. So they can indirectly still send their products to the US. So it's not clear cut, but the biggest damage is really the reputation of the US as the leader of free trade and free market.
We're certainly seeing that in this window of time where U.S. Treasuries, typically a safe haven in uncertain times, are now entering that category of riskier assets, and so money's not flowing in there. Scott Livermore, chief economist at Oxford Economics Middle East. Scott, your thoughts on what are the ramifications for this new status for U.S. Treasuries, U.S. debt, no longer, at least in this window and maybe for a more lengthy period, the gold standard for anchoring the global economy? Your thoughts on that as a thesis, and B, what the ramifications of that could be for energy and the oil markets?
Yeah, good morning, everyone. It's great to be back on. I think Carol kind of captured it. The biggest impact at the moment is uncertainty. investors don't know what's going on. Investors are looking for safe havens. Usually the US Treasury is a safe haven, but investors seem to be piling into gold instead in order to say to find that safe haven. And I think that's largely to do with we're not sure how China's going to respond. China's the biggest holder of US bonds. And if they decide to diversify away from the US, then
well, we've been seeing that in the last 5 years. They've been on a pathway. They did pre-COVID hold 1.3 trillion US treasuries. They've now winded that down to under 800. So they've been on a pathway knowing that this day was coming, I think.
Well, indeed, and it's a gradual diversification, but you still got to ask the question, where else is there apart from the US? And in a world where China still wants to manage its exchange rate against the US dollar, then there's little choice but to hold US treasuries and US assets. And I think to date, we've seen little credible alternative to the US dollar as the reserve currency. And these kind of moves around raise the usual question again. Is it going to be the euro? Is it going to be a BRICS currency, et cetera, et cetera? And today,
or Bitcoin. I mean, Bitcoin is $80,000. This little weird piece of digital code. It's sort of
any of those currencies at the moment offer a viable alternative. So once we move past this uncertainty, and that could take a few months. We have a 90 days window, and that 90 days window could smooth everything out, but it could just be ongoing uncertainty. And the volatility we see in the markets, all markets, is likely to continue. But once we're in that post phase, when you have more certainty about what trade policy is going to be, then yeah, the world could look quite different. But I still think that the US markets are the main safe haven, and they're going to be still dominant, and the US dollar will remain the dominant currency.
Dr. Charles Elinas, CEO of the Cyprus Natural Hydrocarbons Company and Senior Fellow at the Global Energy Center Atlantic Council. Welcome back, Dr. Charles. It seems that one of the legacies of this window, this Trump Liberation Day tariff attack on the world, is European Union union, you know, this idea that there's actually a strengthening in what is quite often a fractured group of 20-odd countries. Your thoughts on that being a legacy of note, and what its ramifications are for Europe's position in the world, and will it last?
Well, there is some tendency for reunification, but I think there are still differences between the various countries. I mean, only yesterday, Sanchez of Spain went to China and had his own discussions with the Chinese. Meloni is going to visit Trump on her own, and the French are very worried about what Meloni would be telling Trump. And the coming German chancellor is sending his own vibes. So Ursula, in between all of them, is trying to maintain a line and trying to maintain a tough US position against the US in the forthcoming negotiations. I'm not so sure Europe is going to be able to hold this. I think the divisions between the various countries are there to be seen most of the time. The European Commission and Ursula von der Leyen are not strong enough to hold it together. And there are a lot of various interests within Europe. Some of them want to, like Germany, for example, wants a compromise with China to enable the German car industry to survive by cooperation with Chinese, or maybe Chinese coming and building the factories in Europe and cooperating with the German industry. And Meloni is seen as an ally of Trump, and some of the other far-right European politicians look at Meloni to find a way to compromise with Trump. So
is she moving more into the Orban circle, or her success to date has been to not do that. Her success to date has to be reinvent herself as a center-right politician rather than a right politician, if you like, in the mold of Orbán or Le Pen. But is she drifting in that direction to please Trump?
No, she's not. She's doing exactly what you said. She's trying to maintain a line of her own. It has been very successful so far. She's trying to maintain that, and partly that is the reason of going to Washington for negotiations with Trump. And that's why the French are also worried, because they know that Meloni is onto a path for Meloni's future. So they don't trust what she's going to do. She certainly won't go the extreme way of Le Pen and Orban.
So Putin, there's nothing for Putin to worry about, that suddenly there's a unified Europe and a counterbalance to his action. Let's think about that and maybe come back to that. Carol, in the midst of all this, sort of, two things happening for the oil markets. Of course, there is all of this Liberation Day tariff, Trump disruption, but there's also at the same time, by coincidence or design, OPEC Plus deciding to increase supply this month. Obviously, that decision was made a while ago, and then recently to accelerate that increase in May next month, which is now a few weeks away, to triple the increase, and then to see, we'll have to see where they go after that. But your thoughts on where OPEC Plus are at the moment, and the next decision they have to make, which is about June, and continuing with these supply increases into a window that is clearly a weakening global economic outlook.
Before I answer this question,
Please.
Sean, I want to go back to the EU thing, and it made me think that there is, of course, we're all putting Trump in the bad guy category because of the shockwave that he has created around the world. But there is also some degree of hypocrisy when it comes, for example, to the EU with their policies, the tax policies, the CBAM, the carbon border adjustment mechanism on the carbon content of imports. That is indirectly a tariff, and that is not only to save the planet, but also to protect domestic industry. So I just wanted to highlight this kind of hypocrisy that we find in certain regions and certain countries when it comes to the policies on tariffs that Trump highlighted. Coming back to the oil market, you're absolutely right. You have the two main, I would say, moving parts: the tariffs affecting impact, the demand through their impact on global economic growth. So they are impacting oil demand, and that is the main concern today. And that is a big concern because it happened at a time when oil demand has not been booming. So remember, we've been talking about it for a while, about the Chinese, the largest crude oil importer in the world, having structural economic problem, and oil demand, yes, is growing. It was not booming as many would have hoped it would happen. So the tariffs hit at a critical point and a weak point when it comes to the demand picture. Add to that, there has not been a shortage of supply. Actually, this year, the world was expecting record supplies coming from outside OPEC Plus, but from the US in terms of growth rate. And also add to that, OPEC Plus deciding to opening the tap. Now, I kept on thinking about why did they do that? You know, we don't sit with the ministers and then to get all the interesting insights. But I've been thinking about several possibilities. One, there is a commonly shared idea that is intended to punish the cheaters because those who are the compliant members in OPEC, led by Saudi Arabia, have been carrying the burden for a while now of those who are not compliant, and their patience has run out, and therefore they want to punish the cheaters. This is not new, and this has been done before by OPEC. But there are two other possible explanations. One of them is that OPEC has come to realize that actually a low oil price environment is here to stay for a while, and therefore it's better to safeguard market share, especially that the conditions are not going to change drastically. Or it could well be that they know something that none of us knows. Primarily, maybe they are expecting a serious loss of supplies from the market, let's say from Iran, from Russia, from Venezuela, or elsewhere combined. So that would be the justification for their action. Maybe there's another fourth reason. I don't know. I can't think of it. But on balance, put all these two factors together on the demand and on the supply, and we have the price environment that we are seeing today.
And your thoughts on whether they can hold that line? I mean, it does appear we've got Brent at $63. It's down $20 from the high of this year in mid-January. Continuing to accelerate the increase of supply. This reminds me of the late 90s, where there was a similar strategy going into the Asian currency crisis at the time. Demand collapsed and prices went below $10. Can they hold this line? It would seem counter to their overarching credibility of balancing the market.
Well, can they hold the line? Well, it depends on what happens in the market. If you have suddenly a sudden loss of supplies somewhere, then yes, they can easily hold the line. If demand recovers and there is an end to the tariff stories, yet they can hold the line. That's why they tell us that their decision is not cast in stone. They will observe and see what they will do. But mind you, yes, you mentioned the 90s. That was a lost decade for the global oil industry. There will be pain, especially for OPEC producers, because they are all dependent, but that the threshold to sustain that pain is not equally divided within OPEC. There are an OPEC Plus, there are those who can sustain that pain longer than others, and there are the cheaters, like Iraq, like Kazakhstan, who would perhaps suffer more, and that could bring them back to the compliance table. So it's all like moving parts, and I cannot say if they can sustain it. It depends on what is happening outside the group on the demand and the supply side.
Scott, speaking, look at that demand side. The idea of the supply question, the big question at the moment has to be, where is China going to go? How is impacted will China be from this whopping 145% tariff into the world's biggest consuming market, from the world's biggest exporting market? Your thoughts on China demand outlook now? Going into this crisis, we were looking at a general consensus global demand growth at 1 to 1.5 million barrels a day, much of that coming from Asia. Where do you think we go now?
Well, clearly it's not good for demand, which is probably the simple answer to that. I think
that would make a good headline on the front of the New York Times. This is not good for demand! Exclamation point.
Keep it simple. But how not good really depends around the world on domestic fiscal policy. And it was always the case before the Trump tariffs that the stronger performing economies are going to be those ones that can support the economies more domestically through fiscal policy. Not directly. You've seen some positive moves in Europe there with the defense spending, and that's going to help offset some of the impact. And you're likely to see in China more fiscal support. They have the ability could spend. There'll be policies to help with the consumer market, the trading schemes that they had. They were already expanding out. There's policies to make it easier for local governments to borrow and spend and support the economy. And you've seen some looser monetary policy. And as a response, I know we're very focused on how they reciprocate, but domestically, you're likely to see much more fiscal support in the Chinese economy to try to support domestic demand. We don't think that's going to offset the impact of tariffs. I think we're likely, and as I'm sure you appreciate, it's a bit of a moving target, but we're revising our forecast as we go. We're more likely to see growth around 4% GDP growth this year and next. So some way below the 5% targets the authorities have been focused on the last couple of years. But it really does depend on how much fiscal support there are. And across Asia, there's going to be winners and losers. Countries like Vietnam, Cambodia, clearly exposed. Some production may be shifted to ASEAN. There's going to be movement in shipping routes. As Dr. Carroll said, it's very much focused on tariffs applied to where goods are coming from on the shipments. If there's rule of origin regulations come in, then that impacts on the ability of some Asian economies to kind of see some trade diversion. But going back, it's not good for demand, and you're likely to see weaker oil demand from China and Asia than we were expecting a month ago.
Charles, the European perspective here, from an energy demand point of view, one of the repeated solutions to the trade deficit with the United States and the European Union is, oh, we will buy more energy from you. We will buy more LNG, buy more oil. Where is amongst these different sort of views from Europe, the Meloni, the Macron, the Merz, the new German Chancellor, von der Leyen, where is there any growing concern that with this legacy fallout of this Trump Liberation Day, that is America a reliable partner? I mean, like we became dependent on Russia, very vulnerable to that, now being dependent on the US being an unreliable partner and supplier of your key energy resource. Where is that in the growing narrative of this time?
Well, certainly Europe is seizing the opportunity. It doesn't see the United States as continuing to be a reliable partner. And they're trying to seize the opportunity to take advantage of that and bolster European industry in Europe. But on the energy side, even during the last few days, the Energy Commissioner of Europe said that Europe is considering buying more LNG to compensate for the tariffs. But it's one thing to say that, another thing to achieve it. First of all, Europe already buys 45% of its LNG from the United States. And the room to buy more at a time when gas utilization in Europe is not actually going up, but possibly on average going down as a result of REPowerEU, the room to do so is not great. And there are also the methane emission regulations that are coming into force, which are going to be a negative aspect with regards to US LNG. US LNG has a high methane background, and that will affect the buying American LNG. On the other hand, because of security of supplies implications, people expect that these methane regulations may be sort of set aside, and the same, Carol, the same may apply to CBAM. CBAM may be watered down because of the developing situation, because Europe is, I mean, we said it before, it's two-faced. It's not sticking to its principles. They are watering everything down at the moment. They're watering down the Green Deal because of competitiveness implications. And there are even talks that Russian gas might come back to Europe. These are continuing. For example, the court in Switzerland hearing the case to wind up Nord Stream, the company, have deferred their decision to next month because they're hoping that the discussions between Russia and the US will produce a positive result and bring the pipeline back. German politicians are already asking for the pipeline to come back. And so,
well, if you're importing LNG, what's the difference in it coming in a pipe? I mean, they've never stopped importing LNG. It's even from Russia at record levels. Let's go to the survey question and get a thought on this theme I've been putting forward to the speakers. What will be the most significant lasting legacy of Trump's tariff liberation day for oil markets, regardless of where we go from here? U.S. Treasuries lose safe haven status, and with that is a general lack of trust in America. U.S. oil industry stop upstream investing because of the unpredictable nature of the cost of money, of the investment, of predictability is the enemy of all investing. China economic slowdown. Clearly, Scott was quite generous with his 4% number. One might be thinking 0% perhaps with an inability to export to the world's largest consuming market for the world's largest exporting. That would be quite a big hit. None of the above. Ultimately, Sean's lunatic, and none of these three ideas will last more than the wrapping on a fish and chip newspaper. So give us your thoughts on that. Carol, we're obviously, a lot of things are I was on a call earlier this morning. A lot of things are getting smothered by inevitably particularly the equity markets collapsing, the now not collapsing because we've changed the whole Trump universe has dominated the oxygen. But meanwhile, Israel's reinvaded Gaza. They're apparently planning a major occupation again, as they had before. Slaughter continues. We got Iran and the US starting to have talks this weekend in Muscat down the road from us. What are some of the things we're not looking at that we need to be just reminded of, do you think, of relevance, particularly for the energy markets?
I mean, there are lots of things we should keep an eye on, even though the headlines can distract us from what's going on. You mentioned Gaza. What's going on in Gaza should continue to be an important headline news that people should keep an eye on. But I want to link my answer to what you said in the poll, because I was thinking about the US shale investors pausing or stopping investing. Now, definitely there is a clear relationship between the oil price and the activity level in the shale patches in the US, and not really policy announcements. And we heard some of the CEOs companies saying that moving from one extreme to another when it comes to policy is not helpful for investment. But because you said lasting legacy, I did not click on that one. I would have added in that poll something that I think Charles alluded to, the impact on the energy transition. And that is something we need to discuss as when we talk about the impact of tariffs on energy markets. And this is where I would link it to my outlook for oil demand, but in the midterm, because I think what is happening today has extended the shelf life of fossil fuels and has decelerated to a certain extent the energy transition. Now, how much deceleration we're going to see, I think quite notable compared to what we had before Trump came to power. So it's not just what he said, the fact that he does not like windmills and he finds them ugly, but the uncertainty he has created and the lower fossil fuel prices that we are seeing today is likely to translate into pushing the peak oil and gas demand for many years further down the line. So that would be, for me, another impact on energy markets that we should be discussing as well.
Scott, one of the things, again, the same question to you, one of the things I've been thinking about, when you take the narrative as the earlier comment by Carol, that what are the reasons, what are the reasons that OPEC Plus has decided to increase supply into a clearly demand weakening environment, to bring discipline within their group is one of the reasons that you hear and mentioned it's through the history of time, but most recently reported upon. But where that stress at $63 Brent, the other big question that does resurface at these times is the cohesion of OPEC Plus. Can OPEC Plus hold together under these duresses, the discipline? If I'm going to be a member of this group, I am, because it's meant to keep it an oil price elevated. If it's going to keep it down among 60, then like Angola, like Qatar before it, and others, I'm leaving. What is your thoughts on the stress of a moment like this, on the outlook for OPEC Plus to stick together?
Right. I think on the whole, they realise they benefit as a collective rather than individual. There's always stresses and strains, and often the stresses and strains are about countries wanting to increase production and not continue to lose market share. Clearly, that often is at the backdrop of a higher oil price. But if they're seeing oil price falling, their revenues are falling, and they're not countries can't increase production. I think kind of collectively, and Dr. Carol alluded to it a bit earlier, that they're slowly pivoting to maintaining a market share, and I think that's probably going to help them keep together, rather than having people cheating or on commitments, and rather than
we have, for a reason, just in the recent days, the Iraqi oil ministry restating their objective of getting to 7 million barrels a day oil production target. We have the UAE already at 5 and talking about going to 6. I mean, these are big challenges to the idea of sort of managing supply to balance the market.
Well, There are these longer-term objectives to increase oil. Oil's not dead in the region as a source of revenues and a source of diversification. And if OPEC Plus is loosening the purse strings, if you like, and allowing production to gradually increase, no one expects to jump there overnight, but it kind of helps these countries feel there's a direction of travel and they're not permanently losing market share in order to somewhat fruitlessly try to prop up the oil price, because that's been met with mixed success over the last couple of years.
Charles, last word with you again on the same kind of thesis. What are we not looking at the moment that could be relevant? Your neck of the woods, we've got Turkey and Israel seem to be in a face-off over control of Syria. The idea of energy routes through Syria, pipelines, East Med gas. Where do you see that story moving? How significant is it, and should we be paying attention?
Well, the discussions between Turkey and Israel are quite important in terms of Syria, but I don't think they are going to help pipelines to Europe. Pipelines to Europe are not coming back. Certainly, East Med gas is going nowhere. We have Egypt that is absolutely desperate for more gas, and there is a huge market there to absorb all of the gas that the region produces. And also at the same time as Israel is talking to Turkey, Turkey is talking to the Kurds inside Turkey, and they are close to coming to an agreement to stop this war between Turkey and the Kurds. Turkey is trying to position itself to take advantage of Europe's move to defense, the investments in Europe on defense. Turkey wants to be part of it, so it's trying to remove all of the obstacles to enable it to do that. But I'm going back to Carol's point about the lasting change. The lasting change is that globally, energy needs are growing faster than ever before. Last year, the energy needs of the world grew by 2.2%, almost double the rate at which we were growing over the previous 10 years. And that is because of climate change is causing changes to the climate, global warming, needing more cooling, winters are colder, needing more heat. We have the data centers, which are coming up everywhere now. Even in Greece, they're building a data center with huge energy needs.
Even in Greece, poor old Greeks, they don't deserve a data center.
And the GDP of countries like GDP per capita of countries like India is increasing very fast, needing substantially more energy. So renewables can grow, and they will grow, but it's not sufficient. We still need all other forms of energy, including oil and gas. And I don't see oil and gas demand peaking this decade, as the IEA has been saying. I see it continuing into the next decade. And despite the problem,
but it's certainly another good question in this moment of no answers is: does this window of time and these events advance or give greater longevity to hydrocarbons in the sense that obviously with the heavy, like just we saw yesterday in London with the IMO discussions there, the shipping regulations, the UN shipping agency was looking to bring in new carbon requirements for shipping, and the US essentially walked out of the room. These are all unknowns, known unknowns, but unknown and unknowns. Oil prices trading at $63 a barrel, that's as tangible as it's going to be. According to the views of this room, U.S. Treasuries is the most significant thing to watch, or losing its safe haven status. That has so many dominoes that fall off of that. It's hard to even get your head around how big an idea that was. And that was what was ultimately caused the Trump pivot this week, was the fact that U.S. Treasuries and the bond markets were unraveling, and nobody quite knew how to digest that. And so the only thing they could do was press that pause button quickly. Thank you so much. As always, Scott Livermore, Oxford Economics, Charles Ellin Aas, thank you so much. Dr. Carol Knackley, all of you have a great weekend. I'm sure Monday, which is only a few days away, will bring lots of surprises. Certainly worth seeing what the mood music's like coming out of the US-Iran talks in Oman, if indeed we get any mood music, but certainly one to watch for the immediate direction of travel of markets next week. Have a great weekend, and thank you so much. All the best.
Thank you.
Bye.